Hello everyone, this is Caleb Franzen with Cubic Analytics, and it is Wednesday, June 22nd after the market close. And I wanted to put together this video analysis for everyone today to kind of generally discuss the broader market dynamics that we've started to see in this holiday shortened trading week, and particularly to discuss the actions that we saw in today's market, considering that it was kind of a choppy, wild session, and we've started to see a couple little anomalies that we wouldn't typically see that I would love to discuss and kind of share with everybody. And so I think broadly speaking, really quickly, at the top of everyone's mind, most likely is what's happening in the asset markets, broadly speaking with stocks in general. And so here in this chart in front of us, we have the Dow Jones Industrial Average. And as it pertains to this chart specifically, we're looking at the price action since January 2020 in daily candles. And this has been some key structure that I've been sharing and highlighting for the past couple of weeks, basically sharing how we're coming back into this critical resistance and support range that I've highlighted in gray. And in real time, we can see how we've started to essentially rally and rebound after perfectly retesting this level. We can zoom in basically just on the year-to-date price action and see that we came perfectly into the level. We never even closed into it. We closed right on it, and we've been able to have 2 sessions of green candles. Now today is a little bit unique because we actually closed down 0.15% after particularly starting off relatively strong in the late morning, early afternoon part of the session. We can see at one point the index was up almost 0.9%. basically indicating a really strong intraday rally. But we weren't able to hold on to that momentum, and actually from the peak to the close, the index fell almost a full percentage point, where it closed, like I said, at negative 0.015%. And so as we look generally speaking at the Dow right now to try to get some implication for what the broader market is doing, the Dow is down less than the S&P and the NASDAQ this year, and the Russell 2000 for that matter, which is somewhat of a logical conclusion that we would expect to see when value and more mature businesses are in the Dow over these other indexes. And so I'm not surprised to see the Dow hold up better than these other indexes. But it's important to recognize that because it's held up the most, if we start to see further signs of deterioration or weakness structurally for the Dow, that would certainly be sign and cause for concern. And so for me personally, I think this is really an official kind of line in the sand, if you will, to enter into a bear market. If we look, let's zoom back in here really quick. If we go from the all-time highs to where we close today, we're down 17.5%. From the lowest close that we've had so far, down 19.1%. So as far as I know, the Dow is the only index that has not officially closed or moved into bear market territory, which is defined as a 20% decline from 52-week highs. And so if we were to fall further below and into this range, right, we would certainly see, like if we go all the way to the bottom end, that's exactly negative 20.5%. So this, by definition, is literally the line in the sand for bulls and bears. So regardless of what you're investing in and what time horizon you're looking at, this is very critical for both long, medium, and short-term market implications and risk on or risk off dynamics. If we continue to see a sustained rebound higher, and perhaps we're able to get back above these former highs earlier from this year, I mean, we could do some very, very crude technical analysis here and basically try to look at, let's go with the second peak here. But it's going to take a substantial rally for us to get back above this resistance trend line, right? In order to get back above it, that would require at least a 12.5% move. So I'm not necessarily holding out hope for that. In my opinion, this is still a great opportunity for investors to be DCAing, but very patiently, because it's very plausible that we do indeed break below this potential and actual support band and enter into bear market territory. So I wanted to start off by saying that. And I find it kind of interesting that stocks are having a hard time rallying and risk assets are having a hard time rallying when we're starting to see a substantial pullback in yields. And so if we look really quickly at the 10-year Treasury yield, we could see some very clean structure here. And this bull flag and resistance range that I was highlighting were all done in real time on Twitter. So if you're not following me there, you're not going to be seeing this real-time analysis that I do share about key structure. But essentially what we're seeing here is a classic breakout, retest, and rebound setup. Meaning we've broken above these 2018 multi-year highs, and now we're actually coming back in to retest them. Now it's not for certain whether or not we're going to use this level as support, but that's the same exact analysis that I was providing to investors when we were back here in this range. We had a 2021 resistance range, we had a breakout at the beginning of the year, and we used it as support multiple times. This is when yields were collapsing due to the ongoing Russia-Ukraine tension and invasion. And what happened thereafter? Yields absolutely ripped higher. So we had a breakout above this resistance range, we had a retest of the resistance range, and rebounds back to the upside. And that's exactly what we're seeing now, right? This again acted as resistance earlier this year, back in early May. We cooled off a little bit. Now we've had the official breakout move above those 2018 highs, and now we're coming back in to retest this range for a potential rebound or continuation move. So this is only for 10-year Treasury yields though, right? So if we look at something like 30-year Treasury yields, we have a little bit more reason and signs of caution. I actually want to switch this to some longer term candles. Let's just look at 2-day, just to fit this in a little bit nicer. But we could see that same 2018 peak is still very powerful and really showing a lot of significance over the market. And so if we're looking here at 30-year Treasury yields at the long end of the curve, we're seeing again that this is acting as perfect resistance in this current cycle, right? So 30-year Treasury yields have risen quite a lot this year, not nearly as fast or as much as the shorter maturity yields, but even still, year to date, this is up 61%. This has been a historic acceleration in Treasury yields. And so for me personally, am I surprised to see 30 years get rejected here? Slightly, but if they were going to get rejected anywhere, this would be the level. And so the key question that should be on investors' mind right now is whether or not this is going to lead to a sustained rolling over. And if we see yields, really kind of cool back down and fall to their 2021 highs, that could be feasible. It's certainly not what I'm planning for. I would expect to see a similar kind of cool down that we saw in May and through the beginning of June, where the 30-year Treasury yield fell by about 10%. It's possible and more likely, in my opinion, that we see something of that nature, followed by another somewhat explosive move and an official breakout above those 2018 resistance levels and the year-to-date resistance level. And so I definitely have a lot of, I'm personally still trying to think about what's happening in the yield market right now, because even if we look at 5-year Treasury yields, we're seeing massive declines here that all started in the middle of last week when the Federal Reserve officially raised rates by 75 basis points. And, traditionally we think of the Federal Reserve and the influence that they have on the market to control interest rates, and as they start to kind of embark on this whole process of balance sheet runoff. But what I've been kind of pounding the table on since November is that yields have tailwinds to rise and benefit to move higher in this environment because of the Federal Reserve shift in monetary policy and because of the increasingly aggressive tone, rhetoric, and policy that they've had to bring forward. If we recall, at the beginning of the year, the market was generally expecting the Fed to raise rates only 2 to 3 times for a total of 0.5 or 0.75% for the entire year. And we had 75 basis points in a single session, right? And as far as I know, the market is basically priced in, I think, 9 total interest rate hikes for this full calendar year. And so in this environment, we've seen as the Fed has become increasingly aggressive, that yields have risen faster than the market has expected. And not only faster than the market has expected, but this has actually been an historic acceleration in treasury yields to the upside. And so if the Fed suddenly raises rates by the most aggressive level that they've done in over 30 years or practically 30 years since 1994, then why is it the case that yields are now starting to pull back? Because they haven't signaled necessarily that they're going to be slowing down. I know a lot of people looked at Jerome Powell's comments in the press conference following Wednesday's meeting and identified a little bit more dovish or softer language that would indicate that the Fed might be more amenable to pausing or shifting their monetary policy in the near future. I didn't necessarily get on board with that sentiment. I still think that the Fed is being historically aggressive and hawkish right now. So I've had a little bit of a head scratcher here trying to understand and digest what is the market doing, right? In a single day today, we had 5-year treasury yields fall 4.5%. And typically, as we know, yields and asset prices have this inverse relationship, all else being equal. And so in an environment where since last 6/14, I don't know what day of the week that was. I think that was last Tuesday. Since last Tuesday, yields have fallen, 5-year yields have fallen 10.3%. But during that same period, since 10/14, or 6/14, which was right here, the stock market is essentially flat. The S&P 500 is only up 0.67. So if we know traditionally that yields and asset prices have an inverse relationship, why aren't we seeing that in the asset markets? And my theory is essentially this. When we see yields fall and risk assets also fall, that is a sign of a risk-off environment, okay? Because traditionally we would expect to see yields fall and asset prices, particularly risk assets, rise to the upside. We would expect to see long duration assets, tech stocks, consumer discretionary, think ARK or the Qs. We would expect to see those rise as yields fall and vice versa. So when we're seeing them both fall, to me that's indicative of a rush to safety in the market, right? Investors are de-risking their portfolios and shifting towards more defensive assets or even the US dollar. Now we've seen the dollar also pull back slightly over the last couple of days. So my perception is that investors now are finally starting to increase their demand for risk-free return in the bond market. And so if we look at bonds really briefly, I don't want to make this into too long of a video. I also, before we do that really quickly, I just want to point out the S&P 500 is retesting a very critical support resistance channel. Is this channel perfect? No, absolutely not. However, the lower bound has acted as support 1, 2, 3, 4 times. We broke below it, it acted as resistance. We hit it today and it acted as resistance. So I would not be surprised if we do see new year-to-date lows. I'm actually going to set an alarm here, set an alert on this level if we do fall below there. I have alerts to see if we do get above, and we haven't hit that yet. So the S&P 500 is also kind of trading in this critical territory and could be signaling that there's more downside or pain ahead. But I do want to cover bonds very quickly. So let's look at the iShares 20-year Treasury ETF. What we can see here, this was something that I was pointing out in real time, is that the ETF had fallen below the 2018 low support level. We came right back in. We had a little bit of a relief rally. We sold off below it, and now we're coming back in. And so if we zoom in here a little bit on this price structure since the year-to-date highs, I just want to point out we did actually close above the support resistance range in today's session. And I mean, look, today this ETF was up 2.75%. That's a massive move for bonds. And so as we look, I'm going to be particularly keen to see a continuation move tomorrow, ideally where TLT gains at least another 1% to the upside. And we start to really see confirmation that this ETF and that bonds in general are able to hold this potential breakout or reversal signal. So we need to be very We really need to have that at the top of the mind for tomorrow's session. But again, we're trading at a very critical level right now. So I would not be surprised to see some unique things happen here. Let's go ahead and look at a couple of different things. Let's look at IEF, I think is the 7 to 10 year. And again, we're going to see some very similar structure here. Let's just zoom out to the long-term range. Last week, I actually thought that we had official confirmation that we were having a breakdown below this critical support range. However, this is why it's so important to look at the weekly close, because we did not close below this level. So that's a great sign for a potential reversal here. It's not a hammer candle. You might be able to call that a shooting star or something of that nature, but that's generally indicative of somewhat of a bullish reversal. So now we just really need to see the follow through and the continuation moves in order to confirm that, right? But I mean, this fund has been absolutely destroyed year to date. I think it's down more than 12%. Let's see here. As of today, yeah, it's down 14.1%. But it's ripped higher from the 614 lows the day before the Federal Reserve's 0.75% rate hike. It's up roughly 3%. A lot of those gains came today, up 1.26% in today's session. But this is going to move a little bit slower than something like TLT because it is a shorter maturity. But if we look at this long-term structure here, right, we're clearly trading at a pivotal and important range. Buyers and sellers have memory. They are reacting in this range at a key level at a time where monetary policy is basically also having historical moments, right? This 0.75% rate hike was the first since 1994. There's one more that I would like to point out, which is ZROS. It's a zero coupon bond ETF. And these are very interesting because they behave somewhat similarly to stocks or other risk assets because they don't pay a coupon. They don't pay an interest payment in this bond. So an investor who would buy the underlying asset of this ETF, the zero coupon bond, would, if they bought $10,000 worth of the bond, they would only receive $10,000 at the end of the 25 years, right? So they're investors who are buying this are basically hoping or speculating that interest rates over the next 25 years are going to fall. And so as interest rates fall, this ETF goes up in value quite quickly. And conversely, right, so this is extremely interest rate sensitive because it doesn't pay any interest. So as the interest rate environment changes, something that doesn't pay any interest is going to be very sensitive and elastic, as economists would say, to those changes in interest rates. And so this fund has been absolutely wrecked year to date. I think it's down over 30%. Exactly 30%. At one point it was down more than 30%, down 34%. But again, we're rallying perfectly on these lows. And in real time, I was starting to speculate that we were seeing the official breakdown move, but we had a massive reversal candle here, and we're seeing continued strength and momentum this week. This fund was up 3.8% today, while the S&P 500 was negative for the session by 0.13. So this is extremely interesting to pay attention to. And so again, we're seeing classic signs of a potential reversal, and now we need to monitor the follow-through action. But again, when we're seeing bonds accelerate this swiftly to the upside on critical support structure, this is indicative of a risk-off environment as yields fall and as stocks and risk assets also fall in this environment. And I think the last thing that I would like to point and touch on is the fact that crude oil prices are falling dramatically. Unfortunately, I erased the key structure that I had on this chart, but it was generally something along the lines of this. I had two levels here, and then I had some different like resistance levels kind of coming in on these ranges, roughly like this. That's essentially how I had it. So crude oil prices have just sliced right through this 7+ month support trend line. This has been perfect support 1, 2, 3, 4, 5 times. We started to see support in yesterday's session, and we just absolutely collapsed yesterday and into today's session. And so, crude is starting to kind of show signs of a rebound off the lows that we experienced earlier today. I think they got as low as 102 a barrel, and right now they're trading right above 104. But this is, again, kind of confirming some of that risk-off sentiment, and we're starting to see commodities start to roll over, right? If we look at where they peaked on 6/14, again, the day before the Federal Reserve's rate hike, crude oil prices have fallen more than 15.5%. And so that's a very significant decline in literally a matter of 7 or 8 days. And so, again, this is showing signs and confirmation of a risk-off defensive market where investors are shifting their appetite and showing demand for risk-free assets, and perhaps starting to get lured in by the yield that was offered on 5, 10, and 30-year treasuries, which, if my memory serves, when all of this was happening last week, was right around 3.5%. And I'm not sure exactly what we could look. Basically, you could divide. Okay, so the 10-year treasury right now is basically providing 3.15% yield. The 5-year is at 3.22, and the 30-year is at 3.24%. So I think investors now are starting to realize we've experienced a historic acceleration in yields, and they need to somewhat capitalize and take advantage of these historically elevated yields that haven't been here in basically 3.5 years. And while the Fed may still be gearing up to fight inflation and continue to raise their aggressive tone and rhetoric, the bond market is starting to show us signs, perhaps, that inflation has peaked. And we need to remember the bond market is considered smart money, quote unquote, right? Relative to other asset markets like stocks or crypto. So if the stock market if the bond market is showing demand at these levels, key levels, despite the Federal Reserve's 0.75% rate hike, to me, that might be saying that the bond market thinks that this 0.75% rate hike and maybe a couple more 0.5% rate hikes is enough to tame inflation, is enough to put us into a soft or mild recession to tame demand and bring it more in line with supply. And so this is something that's going to be extremely important to watch, because it might be the early signs of confirmation or foreshadowing that inflation has peaked and is at least starting to subside, is starting to abate, and could potentially be rolling over. I'm very careful with the words I'm using, because this is still extremely early days. Again, this could just be a cool off within a broader downtrend or uptrend. We don't know yet. So I wanted to put these thoughts together because, again, generally speaking, across the market, we're seeing signs of basically signs of a defensive market that warrant continued risk-off behavior. And could that change in the next couple of days or couple of weeks or month? Absolutely it could. And I'm always hunting for signs of these reversals and shifts in sentiment and market dynamics. And I think this is something that should be on people's radar, because this seems like an important shift in that dynamic. So I'm going to end the video here. I went way longer than I was expecting. If you made it through to the end, congratulations. I really hope you learned something. Again, I do share a lot of this analysis live on Twitter, and be sure to follow me there at Caleb Franzen. I'll leave a link in the description. And then I also provide free weekly newsletters where I discuss macro, the stock market, and Bitcoin data. So if you're looking for key information on that, my broader views on things, and the exact data that I'm using to basically form my investment thesis and look at the broader macro environment, be sure to sign up for that. It's totally free. But I wanted to put this video together to basically combine all of these different things that I've been posting about to really discuss the general themes that I'm seeing across the market. So 25 minutes in, I hope everyone has a fantastic evening or a fantastic day whenever you're watching this, and take care, stay safe. Bye.